What's up, guys? It's Dan from Coin Bureau Trading. Today I'm going to explain why I believe the crypto market is likely to crash in November and December. This is a follow-up to yesterday's video. If this is the kind of content that you enjoy, then be sure to smash that like button, subscribe to the channel, and ping that notification bell. Before we get started, do keep in mind that nothing in this video is financial advice. It's just my personal analysis of the crypto market. Your analysis could be different, and if it is, that's awesome, because the more difference of opinion that we have, the better traders and the better investors we're all going to become. So first things first, guys, I need to acknowledge kind of like the elephant in the room here, and that's that from a crypto market cycle perspective, yes, it's possible that the crypto market could top sometime later this year or early next year. As most of you will know, most people are expecting a Q4 cycle top or Q1 2025 cycle top. You can actually see this in search trends, which I'll come back to a little bit later. But point being is that from a crypto cycle perspective, yes, it is possible that crypto will top later this year or early next year. However, this is unlikely because of the liquidity cycle. So as I mentioned in yesterday's video, of course, Michael Howell, this guy is like a liquidity expert. He's been basically warning that starting in 2026, we're going to start to see liquidity contract. And that's basically because institutions will need to refinance their debt. And because and this is where things get a little bit tricky, most of the money that exists is technically debt. Like people borrow money and then they spend that money. That's where the money comes from. It comes from borrowing. So when people have to repay their debts, that basically results in like, well, okay, now this month I can't buy a yacht or whatever, right? To use some extreme example, right? Or this month I can't hire this 100 employees because I need to use this money to pay down my debts, which now cost more because after some time, the debts have to be refinanced, right, at a higher interest rate. But anyways, key point being is that starting in 2026, we're going to see liquidity contract as debts start being paid back. And not only that, but this is likely to start happening later this year, as of course, some companies will probably, try and do things early, start cutting costs early, start trying to pay back these debts before the refinancing wall comes in, or rather just to prepare for that refinancing wall, right? Some companies might have debts that start later this year as well and whatever. So again, but this is just one kind of headwind on the liquidity front. The second headwind, and this is one that I haven't seen anyone talk about. So if this is the first time you're hearing about this, drop a comment down below because I'm very curious to hear. Starting in the fall, buy now, pay later loans will start to affect credit scores of Americans, of like regular people. For those of you guys who don't know, over 100 million Americans use buy now, pay later loans, which is pretty crazy. It's a pretty mind-blowing statistic. But again, like most money creation, as I just mentioned, most liquidity creation, money creation comes in the form of borrowing. So if you have a scenario where these buy now, pay later loans start affecting the credit scores of like hundreds of millions of consumers, like in Western countries, which are of course the people who primarily like are the biggest cohort of buyers for crypto, what do you think that's going to do, right? Obviously it's probably going to affect their credit scores negatively. It means they're only going to be able to borrow, let's say, I don't know, instead of 100, they'll only be able to borrow 50, just to use a very simple example. Key takeaway being that buy now, pay later loans will probably cause credit scores to fall, and that will result in less borrowing from individuals. So again, institutions, they have to repay, they have to refinance. So you're going to have basically liquidity contraction, money contraction from institutions, and you're going to see the same thing for retail, for individuals, for regular people. You're going to see their credit scores probably fall on average as a result of buy now, pay later loans affecting their credit scores later in the fall. It means they can't get another credit card, can't get whatever, can't take on more debt, can't use that debt to spend money or to buy assets or whatever else, right? Anyways, but this is just two of the three liquidity headwinds coming later this year. Again, this is starting in the fall, right? So again, later this year, liquidity contraction from institutions. Later this year, liquidity contraction from individuals. And then last but not least, we have the liquidity contraction from, of course, the US government with this Treasury General account refill. This is something that a lot of people in crypto have conveniently overlooked. As some of you guys will know, like crypto supposedly, I'm not entirely sold on this, but let's just assume it's true. Crypto supposedly lags liquidity by 3 months. Starting, I think it was in July, the Treasury General account started being refilled because, of course, they raised the debt ceiling. Long story short is that this refill of this bank account at the Federal Reserve, it's technically the Federal Reserve. It's like the U.S. government's bank account at the Federal Reserve. When this gets refilled, it's already being refilled again, like as of July. As this starts to be refilled, this is going to drain liquidity from the financial system. But again, because crypto lags liquidity by 3 months, it means the liquidity drain that started sometime in mid-July is not going to start affecting the crypto market until sometime, whatever it is in November, right? Because it's going to start, in 3 months from now, or maybe you could say in sometime in mid-October, right? So starting mid-October, you start to see liquidity drain, and then that liquidity drain will accelerate again because it's already happening now technically, but it's only going to start impacting the crypto market in 3 months from the time that liquidity drain started, which again was in mid-July. So basically you would be looking at, let's say sometime in mid-October, going into, well, basically the end of the year, you would see a liquidity drain that is also a headwind for crypto. So again, from a crypto market cycle perspective, yes, crypto could top later this year or early next year. However, from a liquidity cycle perspective, a top later this year is unlikely, and a top early next year, in my opinion, is basically impossible because of these liquidity dynamics. Again, starting with institutions having to refinance, individuals not being able to borrow as much, which also results in a net contraction in liquidity, and then of course this liquidity drain from the Treasury General account, which is very real. You could say that, oh, this debt refinancing is hypothetical, and this buy now pay later loan stuff affecting credit scores, that's all hypothetical. You can't prove that. Well, I can show you with concrete data here from the Federal Reserve's website that the Treasury General account has been draining liquidity since mid-July, and as we all know, or as common knowledge dictates, that this liquidity drain that started in mid-July should start affecting the crypto market negatively as a headwind in mid-October. So anyways, if you're enjoying the video so far, guys, then I do want to ask you kindly to check out the deals in the comments or in the description, because we have awesome deals on exchanges here. Binance 20% trading fee discount, $600 of bonuses, Bybit up to $60,000 in rewards, Axiom 10% cashback for life. That's like a meme coin trading platform, 10% off better traders, Aaron's awesome trading course, 100,000 USDT, up to 100,000 USDT welcome bonus on 2bit, OKX 40% trading fee discounts, up to $60,000 in bonuses. The list goes on. All these deals are completely free. Of course, taking full advantage of those deals involves like doing a certain amount of trading or whatever, but these are the biggest deals and discounts that you can get. They're available exclusively through the Coin Bureau, sorry, and they won't be around for long, guys. So do take advantage of these deals using the link in the description. They help you out, they help us out, and of course, they help out our partners. Again, this ties into, I guess, why I believe, an even bigger reason, I would say, why I believe that November and December are likely to be very bearish for the crypto market, and it has to do with lending. I guess it kind of ties into the whole liquidity thing. You see, what a lot of people don't understand, guys, is that the reason why crypto, or I guess one of the main reasons why crypto rallies so aggressively, especially near cycle tops, is because people take on leverage. For example, they'll either borrow, let's say for individuals, they'll be like taking on loans or using credit cards to buy crypto or whatever, right? And then at an institutional level, you'll see people like borrowing against their shares or borrowing against their crypto or whatever, like crypto whales borrowing against Bitcoin or Ethereum, borrowing stable coins against that to invest more into Bitcoin or more into Ethereum or more into altcoins in the ecosystem, right? Key takeaway being is that basically this leverage is like rocket fuel on the way up, but it's like dynamite on the way down. It's something I've been saying in the Coin Bureau Club. And as you guys can see, lending, again, this is CeFi plus DeFi plus CDP stablecoins, so stuff like Athena, right? Or like what's another one? Like I'm trying to remember, MakerDAO's DAI, which I know has like rebranded a USDS or whatever. But point being is that you're starting to see again this surge in borrowing in Q2, and I bet Q3 is going to be even bigger in terms of borrowing. And of course, it's not just in CeFi, DeFi, and these decentralized stablecoins. It's also with all these treasury companies, right? Whether it's Bitcoin or Ethereum, these treasury companies are taking on massive amounts of debt right here, as much as 14 billion. Known outstanding debt issued by Bitcoin treasury companies to purchase BTC. And of course, all these, I know there's a lot of nuance there in terms of like the maturities of these debts or whatever, but in my view, it all kind of starts like with DeFi. And what happens is that, let's say there is some whale who like took on way too much leverage, and then they have to basically sell their collateral, and that causes the price of, for example, Bitcoin or Ethereum to crash. All of a sudden, people start thinking, wait a minute, all these like treasury companies, like they just took on a bunch of debt to buy this Bitcoin or Ethereum, and now it's worth 30% less, right? Or now it's worth 50% less. And what do you think that's going to do? Like, of course, it's going to result in a loss in confidence. They even have it noted in the risk that like, hey, under certain conditions, we might be forced to sell the crypto that we just bought. I think even MicroStrategy has that in like their warning for the SEC. So this is why I think, like, again, rocket fuel on the way up, dynamite on the way down. When we do get this huge rally, I think going again like in Q3 this quarter, potentially extending into October, as soon as you start to see crypto prices turn down, it's not just going to be like a gradual grind lower. I think it could be a very sharp drop as a result of all of this leverage. And what's funny, guys, just as a kind of like fun fact, not so fun fact, historically speaking, October actually tends to be a very bearish month. Like all the biggest crashes happened around like September, October timeframe, right? So if we are kind of heading into some big crash scenario, because this leverage doesn't just exist in crypto, guys, this also exists in TradFi markets, and especially now, given how interconnected crypto is with like TradFi markets with the ETFs and everything, you could see that spilling over into the rest of the market pretty quickly. And some would say like maybe they want crypto to crash so that they can say, hey, we have to now do some kind of CBDC or whatever, right? Like we tried this cryptocurrency thing, it didn't work, so we needed the government or the bank currency, right? We need the banker coin. Some people would say that. I'm just going to reserve opinion there. But the last thing, guys, again, part of the reason why I believe that a Q4 cycle top, like sometime in November, December, is unlikely also has to do with the fact that everyone is expecting it to happen. And I think that this is going to result in kind of like a self-fulfilling prophecy where the moment that crypto prices start rallying, which, by the time you see this video could be the case, everyone's going to be aping in, thinking, oh my God, like this is my last chance to get in. It's going to go even higher later this year or early next year, right? Because that's what everyone expects. And I think that that will actually cause the blow off top to occur in like September for Bitcoin and October for altcoins, as I had been mentioning in yesterday's video. Mostly in this case, mostly has to do with the liquidity cycle and also with again these expectations of a Q4 cycle top. I think those are the kind of like the two things that will potentially nullify or negate a rally later this year, and could actually result in a crash in November, December. And the kind of scary thing is that if people believe there's going to be a cycle top early next year, then some people might be buying the dip, trying to buy the dip, but if they've already borrowed as much as they can, then it's going to be hard to buy that dip in November, December, and that could result in that continued unwind of leverage. Which again, when you're dealing with liquidations, you're not dealing with people that are manually selling. You're dealing with automated selling, and that's a completely different beast. It's like those short squeezes and long liquidations you see on exchanges, but imagine that at a systemic scale, right? It's not something that is just happening on day to day, but it's like something that is happening over the course of weeks and months. So just something to keep in mind there. Anyways, guys, if you did make it this far and you did find that information helpful, then be sure to smash that like button, subscribe to the channel, ping that notification bell, and I'll see you in the next one.